Hey everyone, I hope you're doing well. I've got a super quick video for you today because it's FOMC day, which can sometimes be pivotal for the economy and the markets. Now, I think that the Fed has begun the process of trying to bail out the stock market. And I want to go over today's important Fed Day decision, their details, and what this may mean for the near term and the longer term outlook. So the Fed kept interest rates steady with the federal funds rate at 4.25 to 4.5%. They talked about there being 2 quarter-point cuts this year, and the dot plot was essentially unchanged from this past December's FOMC. Now, the phrase transitory inflation is back, and Jay Powell said that tariff inflation risks are most likely one-off. Now, if we analyze the press release, there were some important subtle changes. They added language that the uncertainty around the economic outlook has increased, and they removed the language saying that risks to achieving employment goals and inflation are roughly in balance. The median inflation estimate moved up to 2.8% at the end of this year, and growth estimates went down to 1.7% by the end of the year. Now, in terms of the voting committee members, 8 FOMC members actually see 1 or no cuts, and 2 members see 3 cuts. But here's the most important part. The Fed is going to start slowing the pace of quantitative tightening, also known as QT, beginning in April by reducing the monthly cap on bond redemptions or sales from $25 billion to $5 billion. And they're going to keep the monthly redemption cap on agency mortgage-backed securities at $35 billion. That's staying unchanged. In plain English, essentially, this means they're setting the stage for reducing quantitative tightening, QT. So what's the next step? Once QT finishes, this puts the Fed in a position to enter quantitative easing if there's a new manufactured crisis. Now, we don't know when QE will begin, but ending QT has the effects of rate cuts for liquidity purposes. So this is definitely good news. In the press conference, the Fed talked about how trade, immigration, fiscal policy, and regulation are going to play a role in their future monetary policy. They're going to look at the incoming data like they always do, and they kept reiterating the following points. They talked about how the Fed could potentially maintain higher interest rates for longer if there's no progress on inflation. The Fed can cut interest rates if the labor market worsens unexpectedly, and they're in a good position with where they believe rates are. So what does this mean in terms of the big picture for the economy, for the markets? So we know that the White House has been pretty adamant about cooling inflation and lowering interest rates. And their method of doing so far, has been to put pressure on the stock market so that the wealth effect makes people want to spend less, consume less. So as of right now, the White House is definitely not the stock market's friend. Now, as of today's FOMC, we learned that the Fed is starting to reduce QT, which is a net positive for liquidity. We learned that they kept rates on hold and kept the message that the Fed is in a good spot. So if you ask me, I would say that the Fed is more friendly to the market right now compared to the White House. Now, I'm not saying that there's a hard Fed put or anything, but this FOMC is definitely more dovish than the one that we saw back in December, where there was no mention really about QT at all. So some progress is definitely being made. Now, a lot of people may be asking the question, why did the market react so favorably today? And my thinking is actually, we can't overthink it. And here's why. A lot of individual stocks, large caps, small, mid caps have been so oversold, so beaten up, that anything that wasn't a shocker today could have been perceived as a relief, a positive. So that's the nature of a relief rally, less bad than feared. One key thing, though, is this. If you recall, the December FOMC sell-off was a pretty pivotal point for markets. The market really struggled to get above that level for at least several months. Now, this March FOMC may be the beginning of what traders call a higher low being put in. Now, in a note to friends ahead of today's event, I talked about a checklist of key language that I wanted to see for the market to rally today, and that's exactly what the Fed did. And so this positive response is definitely welcome. By the way, if you're in my community, make sure to be on my WhatsApp channel because that's where I send most of my private notes. I don't send as many emails out these days. So guys, what's next? Honestly, who knows? I'd like to see the market up as does everyone else, but this is a day-by-day market. Longer term, the Fed has recognized that the economy is weakening and something very wrong could happen if the job market weakens because companies can't plan accordingly because of tariffs. So today's FOMC is by no means the cure to the most recent stock market weakness and economic weakness that we've seen. But from the Q&A section from the conference, the one thing that I do know that would make the market and the economy much stronger is if Elon Musk gets his $5,000 stimulus check for everyone from government savings passed in Congress later this year. That would be massively positive, but that's still to be determined. Net, I am somewhat optimistic that today's FOMC could be the beginning of some stability for the coming weeks. That is until, of course, April 2nd, when reciprocal tariffs come back into the picture, or, of course, Trump's next tariff tweet. Guys, thank you for watching. Have a nice day. I wanted to give you an update on the FOMC. Please subscribe, turn on the bell, and I'll see you next time.